common question people have as they're getting ready to retire is, should they pay off their mortgage right when they retire? Should they just take a big chunk of money out of their retirement accounts and pay off their mortgage? And you would think that this would be an easy answer, but actually it's not. There's a lot of moving parts here. And so in today's video, I want to explore a hypothetical scenario with you. We'll call this couple John and Nancy, and we'll walk through both the pros and the cons of paying off a mortgage early, including things like the growth of their money, opportunity costs, taxes, future financial flexibility, how comfortable they are with investing and risk, what are their financial goals, what's going to help them sleep best at night. So if you're ready, let's dive in and really explore this question of what's the best strategy. And the best is really going to depend on your personal circumstances and preferences, but we'll walk through a scenario and I'll show you exactly how you can do this for yourself. Okay, so we're in the retirement budget calculator and you can see we have John and Nancy here, born June 1959. She was born March 1959, and they're both planning to retire on December 31st of 2027. For assets, we're going to say that they have $1 million in his IRA. They have a house that's valued at $800,000, and they have a remaining mortgage of $356,443. From a budget standpoint, right now they have $9,000 a month of income, but that's going to end when they retire, and then they're going to have Social Security. So she's going to have $2,000 a month of Social Security. He's going to have $3,500 per month of Social Security, and they're going to start their Social Security at their full retirement age at age 67. Of course, we need to be mindful of taxes and how much money they're going to pay in taxes. And then that brings us here to the retirement optimizer, where we can start looking at making changes to their plan to understand what's going to serve them best. In this first model, what we're looking at is we're going to assume that they keep the mortgage. Now, before we get into the analysis and looking at the final numbers of how it impacts the overall plan, let's talk for a minute about mortgages and an amortization schedule and dig a little bit deeper into this mortgage that they have, because they have a low interest rate. So we want to consider that when we're trying to make this decision about paying the mortgage off or keeping it. I'll include a link to this tool in the notes below the video, but this is a amortization calculator that's put out by Bankrate. And you can see what we're assuming here is that they originally borrowed $600,000. It was a 30-year mortgage. The interest rate was 4%, and they took the loan out in January of 2009. So as I'm recording this, this is 2024. We're assuming that they've had this loan for a little more than 15 years. And if we just look at this chart here, you can see this shows us the principal. They have $600,000 that they started with, and by 2039, when the mortgage is paid, it will be zero. The green line represents the amount of interest they pay, and the blue line represents the principal payments. And so you can see one of the things we're going to look at more closely here is the fact that when you have a mortgage payment, more of your payment goes to interest in the early years of the mortgage, and less of it goes towards interest as the loan gets paid down. So later, usually about the 15-year mark is when there's a crossover, but in this case, with a low interest rate, you'll see that that actually crosses over sooner. You'll notice if we run the numbers all the way out to 2039, they will have paid $600,000, the $600,000 that they borrowed, but over that 30-year term, they're going to pay $431,000 of interest. So in order to help us know whether or not it makes sense to pay this mortgage off, one of the things we want to do is come over to the schedule. And in the schedule, one of the things I like to do is come down here to export as a CSV. But you can expand these rows so you can see exactly what's happening with the payments. So the first payment was in February of 2009, and you can see $864.49 went to the principal and $2,000 went to interest. And little by little, what happens is that more money goes towards principal and less towards interest. So if we come all the way down to 2021, you'll notice that it's in October of 2021 that their principal payment is now greater than the interest payment. So in their case, it was about 12 years before they crossed over. As we continue to dive into the amortization schedule, let's look at a couple of key points here. Again, more money goes towards interest than in principal in the early years. As we look through the amortization schedule, again, it was October of 2021 that the principal payments were now greater than the interest. And remember, they've had this loan so far for 15 years. So by the end of December 2023, they have already paid $301,000 in interest expense up to this point. So the question becomes, do we pay it off early? One of the things we want to know is how much interest expense is remaining on this mortgage if they keep it. So if we look down all the way to the end, you will notice that they will have ended up paying a total of $431,000 of interest. But the interest expense remaining from that payoff date, they're thinking about paying it off in January of 2026. So from January of 2026 through the end of the loan, they will have $100,000 of additional interest expense that still needs to be paid. And so that's what they would save if they pay it off early. And what we're going to do next is, the next thing I want to touch on before we get into the plan and we look at all of the numbers combined is people say, yeah, but Jason, I get to write off my mortgage interest. Well, remember, as you go on with paying that mortgage down, by the time you get out to the 15th year, your interest expense is not as great as it once was. So for example, if we just look at the year 2024, you can see their interest expense is projected to be $15,204. Back in 2017, when the Tax Cuts and Jobs Act passed, one of the things that happened that has been really great for most people is that the standard deductions went way up. And so they said that before the Tax Cuts and Jobs Act, about 30% of people itemized deductions. After the Tax Cuts and Jobs Act, only about 10% of people itemize. But if you look at Schedule A, if you're filling out your tax form, again, this is just a hypothetical, but for John and Nancy, we'll say that they had $10,800 of medical expenses, but they had income of $129,000. And so the amount of tax benefit based on those medical expenses is only $1,053 that counts towards itemized expenses. And then we'll say that they had real estate taxes of $6,000. We'll say that their mortgage interest was $15,204. And then we'll say that they gave $500 per month to their church, or $6,000 for the year. So that gives them total itemized deductions of $28,257. The problem, though, for John and Nancy is that their standard deduction is greater than that $28,257. So trying to justify keeping the mortgage for a tax write-off, in their case, just doesn't make any sense because the standard deduction is currently greater than their itemized deductions. Now, of course, the tax law is scheduled to sunset in 2026, and so this all may change, but as of right now, the standard deduction is very high. This is an article that was put out by Forbes, and what it shows is that for 2024, the standard deduction for married filing joint is $29,200. And then because they're age 65, they will get an additional $1,550 per person. So again, your standard deduction is greater than your itemized deductions, and you need to take that into consideration when trying to understand if there's any tax benefit to continuing to keep the mortgage. So as we come back over to the retirement optimizer, what you can see is in this initial model, what we're saying is that they don't pay off the mortgage, they just keep the mortgage. Now, the other thing I want to draw your attention to, the only asset they have in this case is their IRA. It's all qualified money. So if they decided to pay that mortgage off in a lump sum, it's all going to have to come out of their IRA, which is going to create a big tax hit for them. So in this initial scenario, what we do is we assume that they keep the mortgage for the additional 15 years. And of course, that means that they're going to have an additional expense of about $100,000 of interest expense over that remaining period of time. But the flip side to that is they get to keep that money working for them. So we're assuming that they've got a 30-year mortgage that was fixed rate at an interest rate of 4%. In this model, we're going to assume that their money is only growing at 4%. And then we'll look at a couple of different scenarios to see, well, what if they had a higher interest rate? But to start out, we run the numbers all the way down, assuming that they keep the mortgage. You can see in 2039, their expenses drop from $161,000 to $133,000. That's because we're showing the mortgage, the principal and interest expense ending at that point. The blue line is his life expectancy, age 83, and the pink line is her life expectancy, age 86. And so you can see, if we're assuming that that $1 million that they had to start with is only growing at 4% per year, and they're having to take out portfolio withdrawals to help supplement their income, we get them all the way down to her life expectancy, and they still have $459,000 remaining. So the next thing that we want to do in the calculator is we want to come up here and say pay off the mortgage. So now here you can see, let me show you how I built this into the calculator. So right now they have a home loan payment that's $2,864 per month. This only represents principal and interest. And because we're going to pay that mortgage off in 2026 with a lump sum, we're going to have that mortgage payment end at that point. 2026 is when that payment's going to end. And then the other thing I do is I have to create a one-time expense to show that $348,000 coming out. So here's the $348,000 needed to pay off the mortgage in January of 2026. It's only going to happen once, and the start date and the end date are both January 1st, 2026. So now if we come down to the Retirement Optimizer, you'll notice that their expenses in 2026 drop way down as a result of the mortgage being paid off. But in 2026, they have this one-time big lump sum distribution that they're taking out of their IRA. And when you take a big chunk of money out of an IRA, you don't just have to take the money out to pay off the mortgage. You have all this additional tax that you're going to have to pay too. So notice that their tax liability went from $11,865 up to $120,000. That's a pretty big one-time tax hit. Now we run these numbers down and you can see his life expectancy is still the same at age 83 and there's $621,000 remaining. And then she continues to live until age 86 and there's $381,000 remaining. So what we have the ability to do now is to compare the results. And one other thing I just bring to your attention is that I do assume tax rates are going to stay the same as they currently are so that the tax law doesn't sunset in both scenarios. And then I also assume things like the standard deduction and marginal tax rates will go up by 2% per year. So if we just have those two models to work from, we look at his and we say if they keep the mortgage and they don't pay it off early, at the second person's life expectancy, they have $459,000 remaining. And then we can also say, but if they pay off the mortgage in January 2026, they would have $381,000 remaining. So if we're just looking at that one data point and their money's only growing at 4% per year and the mortgage interest expense is 4% per year, you can see they end up with $459,000. It's a better situation to keep the mortgage in that scenario. But we also want to look at how much do they pay in lifetime taxes. So if they keep the mortgage and they just pay it off slowly over time, they end up paying $249,000 in federal income taxes over their lifetime. If they pay off the mortgage in a lump sum, they end up paying $261,000 in taxes over their lifetime, in large part because they took out that big chunk up front and they got hit with that great big tax bill all at once. So again, in this initial model, you can see it's better for them. They will end up with more money at the end of their life and they will end up paying less money in taxes to keep the mortgage. But now we can start to play around with the numbers and we can look at a couple of different things. So let's go back to our first model of keeping the mortgage. And now we're going to assume that their money is growing at 6% per year instead of 4% per year. And we run these numbers down to life expectancy and then we'll come over to the other model, the pay off the mortgage early, and we'll do the same thing over here. We'll increase the growth rate to 6%. And then when we compare them, once again, you can see now because that money has a lot of time to grow and at a higher rate, now keeping the mortgage looks that much better. They have $1 million versus $755,000. And if they kept the mortgage, they would have paid $269,000 in lifetime taxes. And if they had paid the mortgage off early, they would have paid $284,000 in lifetime taxes. But let's look at this one, and let's add one other element to this. So we'll come back over to keeping the mortgage, and we'll say, but yeah, you know, this doesn't seem like a long time, 83 and 86. Now that's average life expectancy based on Social Security mortality tables. But let's also look at this and say, well, what if they live to age 100? So now we'll increase their life expectancy to age 100. We'll still assume that 6% rate of return. And same thing with paying the mortgage off early. We'll come down here and increase their life expectancy to age 100. And so now we'll compare the scenarios again. And you can see keeping the mortgage means that they end up with $532,000. Paying off the mortgage means they end up with $418,000. So again, keeping the mortgage looks like the better solution. Now you'll notice though, one of the things that changes here is because they live a long time, they end up paying more money in taxes. Again, their money's working harder for them, it's growing more. The required minimum distributions are greater because we're earning now 6% instead of 4%. So there's a lot that goes into that tax calculation, but just from that one data point, keeping the mortgage versus paying the mortgage off, they do end up with paying more money in taxes compared to if they just paid it in a lump sum and live a long time, they only paid $356,000 in taxes. So there's a lot that goes into this scenario. You have to understand what your interest expense is going to be. You have to understand what are the tax implications if you take that one-time large distribution. You might want to know how long is your money going to last. Part of this is psychological. Do you sleep better at night by knowing that you're completely debt-free? Or do you sleep better at night knowing that you've preserved that chunk of money that's continuing to work and grow for you and earn that rate of return? Are you going to be comfortable investing the money? Can we get something like a 6% rate of return? Because in order to get 6% or better, you're going to have that money invested with some risk. And can you do that and be comfortable with it? Or would you just be better off having the mortgage completely paid in full? So there's many different elements at work here. One, of course, is what's going to help you feel the best about your financial situation. The other one is just looking at the numbers to say what's going to help you have the most money over your lifetime and what's going to help you pay the least amount of money in taxes over your lifetime. And so when you put all of this together, you can really make an informed decision. I'll include links in the notes below for the different tools that I shared here. I hope you found this helpful. Thanks so much.